learnings, but we're always learning. I feel like this job humbles you so often, and the minute you think you know what you're doing, you get proven wrong. And so you just have to be really eager to learn. And we spend a lot of time doing retrospectives on ways we can get better, whether it's sourcing or underwriting or winning deals, because part of this job is you just see so many companies every day, and you're in so many investment conversations that you're just going to make a ton of mistakes. And even calling them mistakes might not be the right word. You're just going to, you're not going to win every deal.
Today we had Jeff Morris Jr. on the pod. Jeff Morris Jr. is the founder and managing director of Chapter One. Chapter One has invested in companies like Mercury, Supabase, Superhuman, Dapper Labs, and Pipe, to name a few. Morris was previously the VP of Product Revenue at Tinder. In simple language, he was the man behind building Tinder. In his role, he led the revenue team to the #1 top grossing app in the App Store globally. In this episode, we covered very interesting topics around fund building, starting from the founding story of Chapter One, importance of having a differentiated product as a fund manager, how to evolve and stay relevant as a fund manager, advice on fundraising, sourcing, and building relationships with LPs for aspiring fund managers, why one should start a fund or why one shouldn't, why most successful fund managers are also the most humble fund managers out there, and much more. Now I bring you Jeff. Jeff, so good to finally see you on a video chat and speak to you. We have always been communicating over email, and thanks for coming on the pod.
Yeah, really excited to be here. And yeah, I feel like we know each other through the internet, so it's fun to have a chance to record a podcast together.
So, Jeff, a good starting point could be maybe you can walk us through, what drove you into angel investing, and later, what was the founding story of Chapter One?
Yeah, sure. So I was pretty lucky to grow up in the Bay Area, so I always had kind of a understanding of what startups were and what investing was. And I actually didn't think I was going to do this for a living. I wanted to be a screenwriter, so I went to film school and kind of went down a very different career path for about a year or two, and then I realized that this was 2007-8, and there was just so much going on, particularly in social and mobile, and so quickly pivoted careers and moved back to the Bay Area. And I was working at different marketplaces, and I guess when you live in the Bay Area, the way you kind of support your friends, if you have the ability to do so, is you become an angel in their startups. And so I did that for a couple of my friends and really fell in love with just being a supporter to them. It wasn't a big dollar amount, but it was kind of these really cool journeys that you could be a part of as an angel. And it was a good break actually from working on a single startup, because when you're operating, as you know, you're just like banging your head against the wall trying to solve one thing. And when you go home at night, it's nice to have other kind of phone calls that you can talk about different problems in tech. And so I really enjoyed that aspect of it. I didn't take it very seriously as a job, and then I went and worked as the VP of product and revenue at Tinder for about 4.5 years. And that role was really exciting because I was leading revenue, and we became the top grossing app in the world, and really, I think, pioneered with a few other businesses, Spotify, Netflix, this transition from ad products to subscription products. And that new business model was kind of my calling card to get access to a lot more deals, because people would call me and try and figure out how we were monetizing the business and how we were growing Tinder. And it just really kind of made me well known within tech. And as a result, I ended up becoming a scout for Index Ventures. And then I did what a lot of people do at the time. And I got on angel lists and begged everybody to back my SPV, and started to syndicate deals, and gradually built a portfolio where by the time I left Tinder, there was a data room that you could look to and say, hey, Jeff has a track record. And I think for me, doing that was a way to accelerate my career, so I didn't have to go work at another fund. It was because I'd already done so much investing on my own. And I kind of looked around all the different venture funds and talked to a bunch of different partnerships, and realized that starting a fund seemed like a really exciting idea, because I had ideas on things I would do differently than the funds I was talking to. And we're in fund 2, probably year 5 or 6 of doing this, and it's still a lot of fun. It's definitely the challenges are different every year and every fund, and so you learn a lot. And I'm just continuing to love this job.
Got it. So seems like angel investing came organically to you, and you built the brand through your work at Tinder, where the high or the competitive deals or founders start reaching out to you, and then of course you worked as a scout for Index. You were building the brand. Maybe Jeff, we can break down both the Fund One and the Fund Two. What was the experience of fundraising? Also, the portfolio construction. Has the portfolio construction changed from Fund One to Fund Two? And what's the importance of portfolio construction?
Yeah, definitely. So I think everyone's Fund One is an access fund in many ways. Like you're trying to fundraise while investing, and normally you don't have a first close that is like the entire fundraise. And so you end up writing, I think, smaller checks, and your portfolio as a result becomes a little bit bigger and less concentrated. And so Fund One for me was checks. It was a $10 million fund. Initially went out to raise a $3 to $5 million fund and had more interest in the check sizes were anywhere from 50K to 500K. And I thought it was really important to, as the fund progressed, to start leading or co-leading deals to kind of show that ability. And I knew to raise Fund Two, I needed to have some examples of deals, competitive deals that I was able to go win on my own as a solo GP. And for me, it was a real confidence builder because I was oftentimes going against partnerships, like real funds, to try and win those deals, and was able to do that. And I think that really paired with, I had some early success stories within that fund. I was able to go raise a $40 million vehicle in 2021 and paired with an opportunity fund. And so right now we're managing close to $60 million of capital, and we've grown the team quite a bit. And so we're 6 full-time people. And on the first one, it was just me doing everything with AngelList as my back office. And now we're a very institutional fund. And so we feel great about the progress we made. But now the evolution has been show that you can co-lead and lead the majority of deals that you do, which is, I think, a big jump for any manager, because you have to maintain the quality bar of those early access checks and prove that. I think it's really easy to win, to co-lead or lead kind of like the second tier deals, but to really like go to bat against the top funds as a startup, because we think of ourselves as being kind of a startup, as a newer venture fund, is hard. And you have to prove that you can do that repeatedly. And so I think for any manager, that's really the challenge. And there's different ways to get there, but I think that's probably the biggest jump for Fund Two, because then you're going to Fund Three and maybe you want to grow the fund a little bit, and you need to really think about how you're going to grow your check size. And for a lot of people, that doesn't come as easily as others.
Got it. So from starting from being an angel, writing 5 to 25K checks, and then the first one, writing anywhere between 50 to 150, and then the second fund is around leading, which is in writing checks into millions. So it's a different game. Founders want to have you on the cap table. It's not that difficult to write a 25K, even if the deal is very, very competitive. So how, Jeff, have you over the years built that brand, meaning that unique value proposition for both for founders and for LPs? Because the second fund was way, way larger. The portfolio construction was different. What worked for you while you were raising Fund Two?
Yeah, I think we really emphasize the team building aspect. And so I was a part of this solo GP class of 2019, which had a lot of really talented solo GPs, but I was pretty clear that I didn't want to be a solo GP in Fund Two, and that I wanted to build a team that would compete against those funds. I kind of had an idea towards the end of Fund One that I could win a lot of deals, but not necessarily win enough deals to have a compelling portfolio out of a larger fund. And so I really thought about where our value proposition really resonated was being it was based on being a product fund. And so like the fund that will help you find product market fit. And that was based on my background on growth teams and product teams and leading revenue teams. And so we really tried to amplify that. And so we brought in one of the former lead data scientists at Twitter. We brought in folks from Scale AI. We've had people on the team from Facebook and Instagram. And so we all with product, data science, or engineering backgrounds. And we you need to come up with a wedge, like a reason to exist for your fund. And we've made it very clear that our reason to exist is purely to help teams as much as we can find product market fit, because we feel like that's really all that matters if you're a seed stage company, is can you find product market fit within a 2 or 3 year period to raise a Series A. And so that's really been the evolution. I think it's really hard to come into this industry as a new fund and not have a focus, whether it's a value proposition they're focused on or a sector. And I think the best way to do that is to kind of think back to like the early days of why you were winning deals as a solo GP or on your own, and then try to amplify that through adding teammates or really kind of doubling down on a very specific value proposition. And one thing we challenge ourselves to do as well is we're constantly iterating on our fund model and our fund thesis and our outbound messaging to try and, again, it's a search for product market fit, which we tell our founders they need to do. We're always trying to do that with our fund and saying, hey, the world is changing so quickly within early stage venture, and the founder communities change depending on what technologies are emerging, and we need to always be very paranoid about losing our edge and what we think is our version of product market fit. So really every fund we kind of go back to the drawing board and say, hey, over the next 3 to 5 years, how do we stay competitive? And hopefully it's organic to what we think we're uniquely good at.
Mm-hmm. Got it. You touched upon a good point where you're constantly thinking about evolving and getting better, and it's mostly around the game of staying relevant. Jeff, maybe you can talk about what has your journey been around. How do you think about constantly getting better and staying relevant? Because we've seen the last 2 years how the industry as a whole has changed so much.
Yeah, I think it's hard. I think this is probably something that is the least talked about part of venture is it's really hard to stay relevant in our industry for multiple funds and multiple vintages, because the founder community continues to get younger and younger, and as a venture capitalist, you're not getting younger, and so you need to be curious enough to stay engaged with whatever emerging technologies are happening at any given moment, and you need to figure out your wedge to kind of like staying relevant to those founders to the point where they want to work with you and they want to seek you out to be a partner. And so I think it comes back to your value proposition. You need to figure out a value proposition that's timeless and has staying power. So if whatever you're pitching, it better be relevant in 5 to 10 years as kind of what you do best. And then I think another way to stay relevant is to stay as close to the company creation process as possible. So whether we've each fund either accelerated or incubated a couple of companies. I think what it helps us do is really stay close to like the product stack, and just how you build software changes pretty dramatically year over year. If you just I think about what I was doing in 2019 at Tinder, a lot of those processes and software, the softwares we use are already outdated. So I remember our design team was just transitioning from Sketch to Figma as an example. And now if you think about the design industry, like everybody uses Figma, right? I'm sure there's still Sketch users, but that's just one example of, workflows change entirely, and you need to stay close to the building process, I think, to stay relevant too.
Mm-hmm. Guys, just staying curious and doing for the right reason. You got to love what you're doing, and because the things are changing so quickly, and it's, as you said, rightly said, it's so hard to stay relevant over a longer period of time. Jeff, you were, a few weeks back hanging out with a bunch of fund managers. Maybe you can double click on, what were your learnings from that evening?
Yeah, I think there's just a lot of people want to be in venture and want to be creating their own funds. And I think the aspirations when I was first joining the tech industry were to go work on Sand Hill Road. And now, like, the number of people at the conference who were leaving big funds to go start their own fund was really astounding. And so it really brought this back home to me, which is like, you really need to create a different product as a newer venture manager. You can't just come and say, hey, I'm leaving X company or X fund, and therefore I deserve to have my own venture fund. You need to have really a unique angle or focus. It could be a sector. It could be, as I said, a value proposition. It could be a stage. You need to come up with something different. Otherwise, there's just too much competition out there. And then, I think the second part of it, which I don't know if my article addressed it, but I think there's just going to be a lot of venture funds, sadly, that either go out of business or fail to fundraise, like whatever you want to call it. I think it's going to be a really tough time as a fund manager to raise your next fund right now. And so again, this is all a challenge to every manager to figure out, hey, what am I doing that is going to be not only attractive to founders, but also really stand out amongst limited partners. Because if you think about the number of pitches you get every day as a venture capitalist, LPs get the same number of pitches from GPs trying to raise venture funds. And so when you get on a call with LPs, you really need to have a different take on the venture market to stand out. So those are a few takeaways.
Got it. So again, I think there's about 3,000 or more VC funds in India. I mean, in US. So you've got to
In the
have. No,
US.
I meant US. India, we have about 15 institutional funds. It's still a very nascent market. There's going to be a lot of solo GPs and emerging fund managers moving forward. Jeff, with this, maybe through your experience, we can talk about why one should do a fund and why one should not do a fund. Outside of being, let's say, if you have a differentiation, of course, you should go do a fund. But other factors, let's talk about them.
Yeah. I mean, I think first of all, you should do a fund if you truly think there's some version of venture capital you want to practice that doesn't exist in the world. Like if there's a specific idea or some area you want to explore that just like other funds wouldn't hire you to do, that's a pretty good indication that you should start your own fund. You should also start your own fund if you feel like you want, like if you feel the need to create something. I think that's probably like the biggest thing I notice amongst the people I talk to. They have an entrepreneurial spirit. They feel like they're founders, right? And I think people forget a new emerging manager, a new fund is company building. Like you're building a business. You're not just investing in companies. Like you have to build a business. There's a lot of infrastructure and back office work that's required to do this every day. And so you have to enjoy that part of it too. And then maybe lastly, I think you just have to, you should not start a fund if you just want to be like the GP or the main, kind of like the main person, because I don't think that sustains itself over time. This is a very hard job. It's lonely at times too if you're a solo GP. So I think you should really think strongly before you start a fund about partnership dynamics, building a team, kind of like how do you build a franchise, right? I think I see a lot of people leave big funds and they like want to get started right away. They're like, I want to raise a fund and I want to do a first close in 3 months or 6 months. And I'm kind of like, you should kind of take a minute, take some period of time to really figure out what you want to do, because once you raise your first fund, it's such a long commitment. You're signing up for 10 plus years of managing that fund. And I think people often get so excited just to start a fund. They don't do kind of like the pre-work to answering the hard questions like why do you exist? What's your mission? Why will founders want to work with you? Kind of how will you be different? And so
Got it. So Jeff, let's say I have these qualities where I have a differentiation. I'm looking forward to signing it up for the next 10, 20 years. Maybe we can talk about a journey where, let's say, I want to do first fund as 10 million and second 30 or 40 like yourself. How one should go about fundraising? How would one source LPs, build relationships? What kind of LPs one should be reaching out? And maybe you can share your journey.
yeah, I think I got lucky in some ways. In Fund 1, we had a well-known fund of funds come in as our anchor, and they did this through a pilot program where they basically invest a small amount of capital in emerging GPs, and then they say, if you depending on how you do with this smaller amount of capital, will be your anchor in your next fund. So I feel like we had a lot of momentum coming out of Fund 1, and it was just frankly like the fundraise for Fund 2 was fairly straightforward, because I think our performance and our data room looked quite good at that time. And we also, I think, benefited from 2021, I think was obviously easier to fundraise than 2023. And so there was momentum there. We ended up adding one other institutional fund, so a foundation. And at $40 million, it's kind of this tweener size where one part is we had much more demand than 40, but we kept it smaller because that's what we kind of went to market with and told our anchor LPs we would do. But the second part of that is $40 million is an interesting size to kind of raise from institutional funds. They want bigger funds. And so you have to figure out who your audience is. I think for these kind of like $40 to $80 million funds, that often ends up being family offices, high net worth individuals. And then maybe, I think it's very important though to get one or two institutional backers or people who can come back in for Fund 3, because most foundations, endowments, fund of funds, when they sign up for one fund, they're underwriting at least two funds. And so it gives you some stability from a capital planning perspective, that you'll have the ability to grow your team and to at least have some assurances that you'll have a fund three. Because I think when you're trying to build out a team, you need to plan around kind of like that next fundraise, and then fund four. I think for most people, like you really towards like fund three, four have to start showing DPI, and so I kind of think our first fund was that first like fund one for us wasn't really like a institutional fund. So it can almost be considered like our fund zero, because fund one is more, I've heard from institutions like if you're not over $15 million, they don't really consider that to be an institutional fund. So even if you show DPI or 3x a $10 million fund, it's hard for them to underwrite that at a larger fund size. And so, yeah, you're always having to, I would stress if you want longevity, you do at some point need to make that transition to raising from institutions. And the only reason I say that is that's more stable capital. And so when you get a down market like we're in today, you hopefully have some LPs who can stick with you and say, hey, we know the market's tough, but we're here for the next fund. And also that, I think it gives you the ability to go fundraise from other LPs, because it's similar to when when a co-leader lead does pro rata in a startup, you kind of get that that like signal during your own fundraise.
Jeff, maybe we can talk about the learnings, both on the fundraise and in the investing side. Maybe what's something you know now you wish you knew earlier about fundraising, and then the follow up would be, what's something you know now you wish you knew earlier about investing.
Yeah, I think on fundraising, I didn't realize how much of this job would be fundraising. And this idea, again, I think I was really fortunate for Fund 2 that we were able to fundraise so quickly. But I didn't talk to a lot of LPs between Fund 1 and Fund 2. And I feel like that was part of me was thinking like I just need to go find the best deals and spend all my time with founders. And that worked back then. I think now the market shifting to being, I would say there's just way more GPs and LPs can invest in. You really need to build relationships on an ongoing basis. And so, you're always fundraising. I think if you don't, again, like back to the question on why you shouldn't start a fund, if you don't like fundraising, this job's not going to work for you, because you have to be fundraising all the time. And it's I think this is a part that's less clear to founders, is that we're doing the same thing they're doing, just we have to go fundraise from different people. And so a huge part of your job is just fundraising. I think I didn't fully appreciate that. And I wasn't very strategic around managing relationships and building relationships. I kind of learned that over time, and now I think we're getting better. Investing wise, I think I in Fund 1 should have been way more founder driven and less motivated by markets or other factors, because I kind of look back on, and also I could have built a bigger portfolio. I think for a sub $10 million fund, if you meet a talented founder and you think they're credible and they have a track record, you should most of the time invest in their companies, because the number of deals that we passed on that end up becoming large companies is just kind of breaks my heart. And so I think your job in Fund 1 is, again, to prove access and to give a preview of your ability to co-lead or lead deals. But the portfolio construction should be very flexible, because even $50,000 checks in a $10 million fund, if you pick the right companies, can return the fund. And so those are probably two of the biggest learnings, but we're always learning. I feel like this job humbles you so often, and the minute you think you know what you're doing, you get proven wrong. And so you just have to be really eager to learn. And we spend a lot of time doing retrospectives on ways we can get better, whether it's sourcing or underwriting or winning deals, because part of this job is you just see so many companies every day, and you're in so many investment conversations that you're just going to make a ton of mistakes. And even calling them mistakes might not be the right word. You're just going to, you're not going to win every deal. It's just not going to happen. And so yeah, you just have to stay really humble. And I think the best people I know in this business, and I know a lot of older VCs who've done quite well in their careers, you feel like they're doing this job. Like they might as well be in their first fund, the way they like operate. And you can just tell they're highly competitive people, and they're very humble for the most part.
Got it. So on the fundraise side, always be fundraising, and the investing side, there'll be a lot of learning, and stay humble and just be curious and fresh. With this, Jeff, we'll move into our final part. My co-pilot, Alfonso, is asking me to ask you. He's asking, what's your typical day like?
Gosh, it's pretty crazy right now because we have a 10-month daughter. And so she's like this morning is probably a good example. I woke up at 6 and changed her diapers and fed her breakfast and played with her until 8 a.m. and then had to jump off for investment committee. We had a founder who was telling us they were leaving to do something else. And so we had a heart to heart and then prepared for an AGM. So we're having an LP call on Thursday, and I'm going to New York tomorrow at 7 a.m. And I'm going to have dinner and then go to the gym right now. So it's just nonstop, really. And you just have to like the grind because it is. I know there's a lot of memes about VCs being like somewhat lazy people, and it's just not true if you really do this job at like if you aspire to do it at a high level, you really need to work hard. And so I think the memes are funny, obviously, because like VCs are inherently people that are easy to poke fun at, but this is a really hard job, and you really have to sacrifice a lot of your personal life and sleep to do a good job.
Yeah, and especially when you're out there building a firm from scratch, and Jeff, we know you as an operator now, as an investor. What do your friends know you for? Who are you outside of work?
Yeah, I think my friends would say I'm very much a homebody. Like I feel like my weeks are so crazy that my friends don't actually like see me unless they come to my house. And so, but yeah, for the most part, I mean, I have a pretty simple life. I have a great daughter, as I mentioned, and my wife Simone, and we mostly just hang out as a family. And then outside of work, I like to golf when I have a chance and do a bit of traveling. But I wish I had more creative answers. But right now, it's like very focused on building Chapter One and my family, and that's about all I have time for.
Got it. And Jeff, is there anything that you've been wanting to learn but just haven't got the time yet?
That's a great question. Things I want to learn. I mean, there's so many things I want to learn, but I think I wish I just had more time to build software. And so it's not like one of my favorite moments in my career was in 2014. I took a break from everything and I went to a boot camp and learned how to code for 6 months. I'm a really bad programmer, but it was enough to kind of get me to be able to build really hacky prototypes and ship software. And so I wish I just had more time to learn new technologies and build things. That's probably what I would do if I had time. I'm always kind of like working on a side idea. So I'm working on a little mobile app right now, but those are kind of the things like I enjoy if I'm not working or with my family. Like I really love tinkering with software. And so I always wish I had more time to do that.
Yeah, got it. And Jeff, let's say if, for a moment you're an LP, or I would say, what would be the 3 funds that you want to invest in and why?
These are hard questions because sometimes you name a fund that you think is an exceptional fund, then you hear through back channels that the funds haven't performed as well as their brands might suggest. But no, I think I really think of this as being like what funds are differentiated and have a unique point of view on the world. And so probably starting off with Union Square Ventures, USV. I just have a ton of respect for the way they built the firm. I love their thesis-driven model. I think they've been able to identify emerging technologies that often aren't aligned with what other funds are doing, and they stick with them through different market cycles. And so I really admire Fred and Rebecca, and I mean the whole team's fantastic. And so I think highly of them. Founders Fund, I think, has a really unique view on how they operate as a venture fund, which I think is interesting. So every investor, every partner kind of runs their own business within Founders Fund, and there's not a lot of overlap in terms of sectors, and it's a very independent way of operating as investors while being part of a really powerful brand and team. I also love how they're all building companies. A lot of them are CEOs as they invest. I think that's really unique. And then last thing, it's probably a pretty easy and straightforward answer is I just admire the longevity of Sequoia, and so I've been lucky to work with them for a lot of years, and grew up. I knew Doug Leone as a teenager, kind of in the Bay Area, and also I just think they're like the New York Yankees of venture capital, right? They're just such a durable, and they've won so many championships, right? And so when I see excellence and like undeniable excellence, you just want to be around it and kind of learn from it. So I spend a lot of my time. Sequoia's not as public with their processes as other funds, but if you were to watch enough YouTube videos, you could get a feel for the culture, and I think that's really unique. And so I look up to them. But there's honestly, we could do a whole show, and I could probably name 20 or 30 funds. And I'm an LP in a lot of funds too, that I think are just really unique.
Got it. Jeff, thank you so much for coming on the pod and really, sharing your journey and learnings of building Chapter One. Thank you so much for doing it.
Yeah, appreciate it.